This is the first of a series of talks I'll be giving throughout the year. The first talk here is called A New Way of Thinking About Money. Do you consider yourself a free thinker? In my opinion, a free thinker is someone who has the ability to change their beliefs based on new information and is willing to act once this new knowledge is realized. Ignorance is a temporary condition that is cured by knowledge. Insanity is to expect a different result by repeating the same mistakes. It isn't what we know that gives us trouble. It's what we think we know that just ain't so. That's a quote by my good friend Will Rogers. You gotta love Will Rogers. What's the definition of an opinion? Well, everybody has an opinion. An opinion is a view or judgment formed about something, not necessarily based on fact or knowledge. I kind of like the Joe Friday approach. The facts, ma'am, just the facts. So today, let's talk about the facts. My father had many opinions on many subjects. His opinion on money and how to use it is: work hard, paying in cash is king, don't borrow money, and put back 10% of your earnings into a savings account. That's what my dad told me. This brings us to lesson 1. We'll call this one Banks versus You. So, you put $100 into a bank account. The bank gives you an interest rate of 1%. Right. The bank then loans out your $100 to customer and charges them 5%. Now, in your opinion, how much more interest did the bank make? Think about it for a second. If you said 4%, don't worry. The bank actually made 400% more than you did. Let me repeat that. 400% more than you. Now, how does that make you feel? Oh, by the way, I hope the bank sent you a nice thank you note for your money. Right. Let's move on to lesson 2. We're calling this one, Let's Buy a Car. Now, the car costs $30,000. Now, you have $30,000 in your savings account so you could pay cash for it, just like your dad told you to save your money up. But now the banker comes in and says, now hold on, how about this idea? We'll sell you a 4-year $30,000 CD that earns 4% annually. Then we'll loan you back your $30,000 using the CD as collateral for the loan, and we will charge you 6% interest a year for 4 years. Well, what would you do? Albert Einstein was a pretty smart guy. He discovered the most powerful force on earth. That's right, compound interest. If you'd paid cash, paying cash would cost you $1,378. How did we get that? Well, the 4-year CD would earn you $5,196. The 4-year 6% loan would cost you only $3,818. That's how we came up with the $1,378 you just lost. So paying cash for the car leaves you no money in your savings account. Now, if you were your own bank using the same formula as above, at the end of 4 years, your new car is paid off, and you would have $39,914 in your personal bank. Savings account has 0 versus the bank of you has $39,914. What would a free thinker do, you think? This brings us to lesson 3. Now, this is going to deal with institutions like Edward Jones, Charles Schwab, Morgan Stanley, Fidelity. You know, the ones that kind of sell you these mutual funds. So here, let me tell you what I'm going to do for you. Over the last 4 years, my clients have averaged 25% return on their investments with me. And I can do the same for you. Now, just make me out a check for $100,000 so we can get started. Would you want me to handle your money? Now think about that. Here, I'm actually going to tell you this. I'm actually telling you the truth, technically. Now, here's the reality. This is how this works, so pay attention. The first year, we make 100% gain, so now we have $200,000. But the second year, we lose 50%. We're back down to $100,000. Third year, 100% gain, back up to $200,000. Then we lose 50% of that, so we're back down to $100,000. Now, here's the math. 2 years, we had 100% gains. That equals 200 total gain. For 2 years, we had 50% losses. That equals 100% in losses. Subtract the 100% loss from the 200% gain, And that leaves us a net gain of 100%. Now, divide that number by 4 for the average return of 25% for each year I managed your money. So we started with $100,000, and now you have $100,000, you think. But hold on, we need to subtract my fees. Now, fees can average anywhere between 3.1% all the way up to 4.7% for each year that I manage your money. For this one, we just picked 3.5. So that comes out to, after 4 years, you gave me $100,000, you have $79,000 left in your account. You paid me $21,000, which I then went out and bought myself a new boat. So, thanks. Let's talk about the side effects of money that is at risk. What I'm talking about is mutual funds, things along that line. Stress is a big side effect when your money is at risk. When we are stressed, the following happens. Your blood pressure rises. That's known as the silent killer. Breathing becomes more rapid. Your digestive system slows down. Things like acid reflux, irritable bowel syndrome, weight gain. Heart rate rises. Your immune system goes down, which is allowing things like cancer and other illnesses to come into play. Your muscles become more tense, and with stress, we do not sleep. We wake up in a heightened state of alertness, worrying about what's going to happen. Will I have enough money? What's going on with the stock market? What will I do? How can I pay for this or that? And here's something else. Let me tell you, Uncle Sam has some big problems. $16 trillion in debt, the questionable future of Social Security, Medicare being privatized. The Federal Reserve has already raised the interest rate once, and with that, the markets usually go down. All of these facts are creating, you guessed it, more stress. Now, I'm 64 years old, so I'm a baby boomer. What is the number one concern of baby boomers today? Well, it isn't their health, it's outliving their money. We don't want to be 85 and saying things like, "Welcome to Walmart. Hi, may I help you?" Let's switch gears just for a minute. What do you think is the main reason people buy life insurance? If you said death benefit, you're right. We all want the highest death benefit for the lowest premium. Well, cheap term insurance. 99% of all term insurance is never used, so that's just money thrown out the window. Other insurances like final expense, some universal life insurance, they don't gain any cash value inside the policy. It's all about the death benefit. Here's the definition of a paradigm. Now, it's a model or pattern for something that may be copied. A theory or a group of ideas about how something should be done, made, or thought about. Now, the infinite banking concept is a major paradigm shift for most people. What is the most money I can put into my own bank? The more money you put in, the more tax-free gains you make. Now, are you ready for a new way of thinking about how your money can be used to help you and not the bank or the politicians or lobbyists or Uncle Sam who always seems to want more? What is the best-kept secret that billionaires like Warren Buffett and Bill Gates have been using for years? Any ideas? They use the cash value inside whole life insurance from a mutual non-direct recognition insurance company. What a mouthful, huh? This will be the subject for our next talk. You can take back the control of your future. You can provide security not only for yourself, but security for your spouse, children, grandchildren, and great-grandchildren. Stop letting the banks and other institutions use your money to make money for them. You can become your own bank. Life insurance should be used while we are still alive. The gains grow 100% tax-free. You and your family would keep the money tax-free, and not Uncle Sam. Guarantees, tax-free income has never lost money in over 120 years, providing a true legacy for generations. Wasn't that something you think you'd want? So in conclusion, I hope some of this might have opened your mind about how money works. So to all the free thinkers out there, welcome to a new way of thinking on how money will and can work for you.